What's up, everybody? CAVA just reported earnings. It wasn't that pretty. Growth wasn't great. Stock was down almost 17% in a single day. If you watched the previous video I made on CAVA a couple months ago, you know that I like the food, I like the company, but I said I thought the stock was just way too expensive. The price at the time was $90 a share, so it's down $20 from that video, down more than 50% from their peak. So we're going to dive into these earnings, see what we could expect for a return on our investment investing in CAVA stock today. Maybe it doesn't look as bad after the drop, or maybe we should still stay away. As always, if you get value out of the video, subscribe to the channel. I cannot believe that we have passed 2,000 subscribers here, so thank you so much to everyone who's followed along. Now, let's jump into CAVA. CAVA, for those of you who don't know, it's kind of like a Mediterranean Chipotle. They make these little Mediterranean bowls. You pick your own base and protein. It's pretty nice. Again, I really like it. It is the only fast food restaurant that my wife and I will eat at. If you want a reasonably healthy meal and you don't have a lot of time, I think CAVA is probably one of the better choices out there. And it's not just compared to Chipotle in terms of the whole vibe and the pick what you like format. It's also compared to Chipotle as a growth story in the restaurant space. Chipotle, over a decade in the early 2000s, went from about 300 locations to 1,400 locations. It was a huge success, and it's what a lot of people are thinking is going to happen to CAVA here. But don't be too confused by this graph. The blue bars, which represent CAVA stores, only the first, 2 and I would say 2.5 of these blue bars are actual numbers. The rest, this is just an estimate of where they think growth is going to be. There are only about 400 CAVAs right now, so they are a far cry away from, these 1,000 store numbers. There are many, many restaurant chains that people get all excited about and think, it's going to be the next big thing. I'm thinking of maybe like Sweet Greens right now. And then it turns out, it's pretty hard to have a really successful restaurant. There's a ton of competition. Things go in and out of fashion. Having a durable brand that lasts for many decades in the restaurant space is the exception, not the norm. So going back to CAVA's results for this quarter, revenue top line was up 20%. That sounds great, but this is actually a slowdown from where they have been growing, and the real slowdown came from same-store sales growth. You can grow revenue by opening more stores, opening more CAVAs, but the CAVAs that have been open, what do their sales look like year over year? What this number is telling us is that, if we ignore the CAVAs that have recently opened, their new CAVAs, if we just look at year over year top-line growth of pre-existing CAVAs, they have grown at slower than the rate of inflation. Basically, sales have been close to flat. They aren't getting more foot traffic in their stores. And this is not what we've seen CAVA report over the previous quarters. Same-store sales growth, this number has looked excellent in past quarters. We see here over the past year, they've highlighted double-digit same-store sales growth. So to see this number drop to 2%, I think was a little bit disappointing for a lot of investors. And while revenue may be up 20% year over year, which sounds great, quarter over quarter, it's actually down quite a lot. For the rest of these numbers, restaurant level profit margins of 26%. This isn't bad. To compare this to, maybe Taco Bell is about 25, 26%, and Chipotle, who again, they're often compared to. Chipotle, I think, is about high 28s, maybe close to 29%. So this number is in between Taco Bell and Chipotle, not quite up to Chipotle's efficiency, but certainly this is not a bad metric. They are reporting positive earnings and positive free cash flow, but these numbers are very small compared to the size of this company. Keep in mind, CAVA, it's trading for about $8 billion right now. So these numbers are very small, but it's growing. They recently flipped into profitability. Margins are improving on an operating income basis. They just turned profitable a couple years ago. So we'll see when we're forecasting where I think, margins might end up. They do a nice job making the stores look pretty in this slide deck. I think CAVA, looks nicer than your average McDonald's or Taco Bell or something like that. But I must confess, I've never seen a CAVA look as nice as any of these pictures right here. But I guess that's their job with the slide deck. Now, let's look at their 2025 guidance. Their updated guidance is pretty similar to what we looked at in the last quarter, but they are saying they're going to open a few more restaurants than they originally thought, 68 to 70 now, as opposed to 64 to 68. Restaurant level profit margins of 25% is the same as what they said before. Adjusted EBITDA, same as what they said before. Opening costs are coming in a little bit higher, but really the number that everyone is looking at here is same store sales growth. It doesn't look like a big change. 4 to 6% they're saying now, as opposed to 6 to 8%, which is what they originally said. But CAVA is supposed to be a huge growth story. This is not a cheap stock. When you have a company that is priced to perfection, that investors think, they're going to blow their numbers out of the park, they're going to come in at the top end of their guidance range, maybe they're even going to increase their guidance, once you see a crack in the growth story, it can have a really negative effect on the stock price. Suddenly investors say, you know what, I'm not willing to pay 60 times earnings for a company like this. And you can have a really big sell-off when the stock is trading for such an expensive multiple. Keep in mind, relative to other fast food restaurants, this level of same-store sales growth is not bad. Just to compare to what their peers reported for same-store sales growth, we see Chipotle down 4%, Pizza Hut down 1%, KFC, McDonald's, Burger King, they're all kind of up 2%, similar to CAVA. The outperformers this quarter were Taco Bell and, surprisingly, Applebee's, which maybe we should look at Dine Brands soon. This is the company that owns Applebee's and owns IHOP. They are only trading for a single-digit multiple of earnings right now. They have an insane dividend yield. For clarity, I do not own this company. It's something I looked at briefly recently, and I've been meaning to do more of a deep dive. The stock is down massively. Over the past 5 years, they peaked at about $100 a share, and now they're down to about $20. In any case, CAVA is trading for a much more expensive multiple than almost all of these companies. So even though the guidance on same-store sales growth doesn't appear bad, the expectations were way higher here. One thing they talked a bit about on the earnings call, although it's not really in the presentation, is some new protein options that they're testing out. They say, we've been testing chicken shawarma in Dallas and Tampa markets since late April. We're very encouraged by the results. Looking on Reddit, it seems that most people are pretty happy with these protein choices. This user said shawarma is getting eaten up at the Florida locations. We have 8 mains on the line and customers just want steak and shawarma. This user said, I think they will full launch the shawarma. It's on fire in the test markets. These premium proteins are very profitable for them. They have a higher margin on these items because they charge you an extra few bucks. Last year, they introduced steak. It's still really popular. In addition to chicken shawarma, they are also testing out salmon. This is something I'm excited about. I love salmon. This person on Reddit says, Florida employee here can confirm we started serving salmon a week ago. It's cooked to order, and in my opinion, it's disgusting, although they later say they're just not a fan of fish in general. So who knows? For $3, I would definitely try out the salmon. If they introduce this at the CAVA near me, they will definitely be getting my money. On the earnings call, management talked up the quarter a little bit. They were trying to justify the same-store sales numbers. They said, last year, our 2024 class of stores did so well that it's making the same-store sales in this quarter in 2025 look kind of bad. But that's because we're comparing to a great class from last year. There was this honeymoon period. Lots of people were going to CAVA. They mentioned a couple times on the call steak lapping, which is a term I think I never would have heard in an earnings call ever. But basically what they're saying is last year we introduced steak in this quarter. It was a huge success. People really liked the grilled steak. It was at a premium price. And, that was a big success in this quarter a year ago. So now same-store sales in 2025, it's making them look even worse. They were asked point blank by an analyst, can you help level set where you're trending in the third quarter today, given how far we're into the quarter at this point? And management said they're seeing improvements in quarter 3 in same-store sales. So it's possible that this 2% number for this quarter is a little bit of an outlier, but still, I think everyone who is, saying CAVA is going to grow 25, 30% every year for like 5, 10 years, they have to relook at those assumptions and ask themselves, how realistic is this? And with that, I think it's time to get back to our sheet, look at the numbers we had last time we made a video, and see what we can expect for a return on our investment if we buy CAVA stock today. Now, the numbers I have in here for my base case are not actually what I think is the most likely scenario. Last time I made a video on CAVA and the stock was trading at $90 a share, I was just to make a point saying, even if you assume that revenue grows 25% every year for 5 years, and even if you assume the operating margin gets basically close to where Chipotle's operating margin is, and even if you give them a 25 times multiple, which remember, this isn't some fancy tech company, it's CAVA. They sell Mediterranean bowls. Even if all these assumptions came true, which I think are rather optimistic assumptions, I was looking at the time a 1% annualized return on this stock. Basically, even if you put in great numbers, you are not making money on this stock even after 5 years. Now, today, with the price down to $70, it looks like you would make an 8% return every year for 5 years if these assumptions came true. So if you think these are reasonable assumptions, you're probably getting a return similar to the market by buying CAVA stock. But for me, these aren't really conservative assumptions. In particular, the top line growth, 25% every year for 5 years. We're basically assuming CAVA revenue goes from $1 billion to $3 billion in 5 years. That's certainly possible, but this is definitely on the optimistic side of things. In this quarter, top line revenue grew about 20% year over year. And as this company gets bigger, as they open more and more stores, it becomes harder to maintain that revenue growth. So I think even giving them 20% revenue growth for 5 years, I think this might even be slightly optimistic for a base case. Operating margins, I think putting them at 15% after 5 years is reasonable. For comparison, Chipotle is about 17 to 18% operating margins. The store level profit margins for CAVA are slightly less than that of Chipotle. So having CAVA get close to Chipotle's operating margins after 5 years, this is reasonable, certainly not pessimistic. I can't give them any credit for free cash flow. They're certainly not going to be returning cash to shareholders anytime soon. They need all this money to open more CAVAs and fuel this growth. And even if I keep their multiple at 25, which is definitely a premium multiple, you're only getting a 3% annualized return on this stock today in this scenario. As far as the bear case, what I have here isn't even really that pessimistic. 15% top line growth every year for 5 years. I'm still giving them 15% operating margins, and I'm giving them a 20 times multiple for a fast food company. It could certainly get a lot uglier than this, but just with these numbers, if this scenario comes true, which is not an unrealistic case, I think, you are losing 6% of your money every year for 5 years. And as far as what the potential upside is, I gave them about the most positive assumptions that I thought were, still reasonable. 25% revenue growth every year for 5 years, operating margins exceeding that of Chipotle after 5 years, and I am giving them some credit for free cash flow a few years from now. With a 30 times multiple, you're looking at about 20% annualized return on this stock today. So if this scenario comes true, then yes, CAVA would be a great investment. But what I see from a lot of investors when I read posts on people who are bullish on CAVA, who own this stock and think that it's a great investment, is they are basically assuming that this bull case is going to come true. They're assuming the future success of CAVA before it's even happened. There are so many restaurant chains that people thought would be the next, McDonald's or next Domino's or next Chipotle or something like that. The truth is very few are. CAVA might be the next Chipotle, and it's possible that it is an incredible investment today. But the future is never a guarantee. There's a range of possibilities, a spectrum of unknowns that might happen. In my mind, this bear case, this bull case, they're both possible, everything in between. And, honestly, even this bear case, I could imagine a scenario that's worse. In summary, when I look at this, I just don't think the risk reward for CAVA is that great, even after the price has dropped to $70. A comment on my previous video about CAVA said, wasn't the IPO price $40? I don't think it will ever return to that. So what price point are you looking at entering? My response to that comment at the time, which is still basically my opinion on the stock today, was my base case values CAVA in the low 50s, but I wouldn't be interested unless I could enter for significantly less than fair value. So maybe around $35, I would start being interested. If it never reaches a price I like, which is very likely, then that's fine with me too. I want to just reiterate that last part for a second because to me, that is so much of what investing is about. I'm looking at a range of possibilities for the stock. I'm getting a price that I think is fair value, and I want to buy for significantly less than that fair value price. You are never forced to buy a stock. If you think that a stock will never get to your target buy price, that's not a reason to just go and buy the stock at a higher price. I like CAVA the company. I would like to own this stock in my portfolio if I could at a price that I thought offered me excellent risk reward. But if that price never comes, if I'm never offered that price by the market, I'm okay never owning CAVA. That's fine. There's no stock you have to own in your portfolio. And this is just my opinion. You might have different assumptions that you make about the future. Maybe for you, at $70, you think the risk reward for CAVA is good today. That's okay. We can disagree. This is not a recommendation to buy or sell CAVA. This is just my opinion, and I just tell you what I'm doing with my money. And for me, I might be using my money to buy CAVA's grilled chicken and lentil and hummus bowl. Amazing value there, in my opinion. But as far as CAVA stock today, it is still a pass for me. If you got value out of this video, subscribe to the channel. If you agree or disagree with anything I said, let me know down in the comments below, and I hope to see you all in another video.